While everyone was watching the Federal Reserve on December 10th, 2024, silver quietly hit $62 per ounce. That's a 12-year high. But here's what you need to understand. The price isn't the story. The real story is what China did 41 days earlier that nobody's talking about. On October 30th, 2025, China's Ministry of Commerce issued announcement 2025 number 68. You probably didn't see it. Most financial analysts missed it completely. Buried in the bureaucratic language was something that changes everything. Starting January 2026, any company wanting to export silver from China must produce at least 80 tons annually just to qualify for an export license. Let me put that in perspective for you. Most silver exporters in China produce 10 to 30 tons per year. They've been doing business for decades. They have relationships, contracts, customers waiting for their shipments. China just told 90% of them they're done. This isn't a regulation. This is an elimination. Think about what that means. In 2024, China exported $3.7 billion worth of silver. That's 13% of global supply. You might be thinking 13% doesn't sound like much. But here's the reality. Western markets, particularly London and New York, depend on Chinese exports to fill the gap when their own inventories run dry. And right now, they're already running dry. In October 2024, China shipped a record 660 tons of silver to London in a single month. Why? Because the London Metal Exchange was in crisis. Physical silver had vanished from warehouses. Premiums spiked 15 to 20% above spot price. Short sellers were trapped with no metal to deliver. China bailed them out. They opened the vault and shipped record amounts to prevent a market meltdown. But here's the trap nobody's seeing. China just spent down its domestic inventory to rescue Western markets. They played the hero. And now they're slamming the export door shut for 2026 and 2027. You saved us once, they're saying. Don't expect us to do it again. Look at what else happened in the 72 hours after China's announcement. On November 1st, 2025, the U.S. Geological Survey added silver to the critical minerals list. That's the same designation that allows tariffs under Section 232 national security provisions. 2 days later, on November 3rd, Shanghai silver inventories hit their lowest level in a decade. Then, on December 10th, silver breaks $62, up 23% in just 30 days. You think that's coincidence? Pop quiz. What are the odds that China announces export restrictions? The U.S. declares silver a critical mineral. Shanghai inventories hit decade lows, and prices spike 23%, all within 40 days of each other? This isn't a policy decision. This is a calculated supply squeeze disguised as environmental protection and resource management. China's playing chess while Western markets are still trying to figure out the rules of checkers. Here's what should grab your attention. China isn't locking down silver because they hate us. They're locking it down because they need it. In 2024, China increased its solar capacity by 45%. Think about that number, nearly half again, as much solar capacity in a single year. And solar panels consume 232 million ounces of silver per year. That's 19% of global demand. Unlike jewelry or coins where you can substitute materials, you can't substitute silver in solar panels. It's the most electrically conductive metal on Earth. Copper doesn't work. Aluminum doesn't cut it. There is no plan B. Every single solar panel requires silver paste for conductivity, and China produces more solar panels than the rest of the world combined. Do the math with me. China's domestic solar demand is growing faster than global mine supply. Every panel they manufacture pulls silver out of the export market and locks it into Chinese infrastructure. So they're making a choice. Keep the silver at home for our solar revolution or export it to competitors who are trying to catch up. They chose option A. Now, let me show you where this gets sinister. The state trading management system means only government-approved companies can export. You want to export silver from China starting January 2026? You need to prove you produced 80 tons in 2024. You need continuous export activity from 2022 to 2024. You need ISO 9000 and ISO 14000 certifications. You need a credit line of 200 million yuan. That's about 28 million US dollars. Translation: If you're not already a state-controlled giant like China Non-Ferrous Metal Mining Group or Zijin Mining Group, you're done. Finished. Out of business. Have you heard this story before? You should have. This is the rare earth playbook. In 2010, China controlled 97% of rare earth exports: dysprosium, terbium, neodymium, the elements that make our smartphones and electric motors work. When Japan contested Chinese territorial claims over disputed islands, China cut off rare earth shipments overnight. Japanese tech companies couldn't get the materials they needed. Production lines shut down. Billions in contracts evaporated. China proved they could weaponize resources without firing a single shot. Now they're doing it again with silver. But here's what makes this scarier. Silver powers more critical systems than rare earths ever did. Solar panels, semiconductors, 5G networks, electric vehicles, AI data centers. Every technology we're betting our future on requires silver. And China just locked the vault. The financial media is still talking about supply-demand imbalances and technical breakouts. They're analyzing chart patterns and momentum indicators. They're completely missing the geopolitical chess move happening in real time. China just locked $3.7 billion worth of silver inside its borders before 2026, while Western markets are already in shortage. Solar demand is exploding, and the U.S. just declared silver a critical mineral for national security. This isn't a market development you track with technical analysis. This is a pre-positioning move for a resource war, and it starts in 36 days. You have 1 month before these export restrictions activate. 1 month before Western markets discover what happens when 13% of global silver supply disappears. 1 month before solar manufacturers, electronics companies, and automotive producers realize they can't source the metal they need to keep production lines running. The question you should be asking yourself isn't whether this matters. The question is what you're going to do about it in the next 36 days. Let's start with the numbers that Wall Street doesn't want you to see. The silver market has been in deficit for 4 consecutive years: 2021, 2022, 2023, and 2024. 4 straight years where demand exceeded supply. The cumulative shortage? 678 million ounces. To put that in perspective, that's equivalent to 10 months of total global mine production just vanishing into thin air. Think about what that means for your investments, your purchasing power, the technology sector you might work in. Where did it go? Industrial consumption. Solar panels eating up 19% of supply. Electronics manufacturers in Taiwan and South Korea pulling metal for semiconductors. Electric vehicle producers in Detroit and Shanghai needing silver for sensors and battery systems. 5G infrastructure build-out across 3 continents. AI data centers requiring silver for cooling systems and electrical contacts. These aren't luxury items we're talking about. They're the backbone of the modern economy, and every single one requires silver in quantities that keep growing year over year. Here's the problem you need to understand. In 2024, global silver demand hit 1.21 billion ounces. Mine supply? Only 835 million ounces. That's a 385 million ounce gap. For context, that's equivalent to wiping out Mexico's entire annual production, and Mexico is the world's #1 silver producer. Imagine the largest silver-producing country on Earth just disappearing from the supply chain. That's the deficit we're running right now. You might be thinking, wait a second, silver is at $62. Why don't miners just produce more? Great question. Here's the trap that catches everyone who doesn't understand commodity markets. 70% of silver isn't mined for silver. It's a byproduct. When you mine copper in Chile, you get silver as a bonus. When you mine zinc in Peru, silver comes along for the ride. When you mine lead in China, silver is what they call the consolation prize. This means silver production is fundamentally tied to copper, zinc, and lead prices, not silver prices. Think about what that means practically. Even if silver hits $100 per ounce, a copper mine in Chile isn't going to magically produce more silver. They're mining for copper because copper prices justify the operation. Silver is just extra revenue on the side. The mine production stays exactly the same, whether silver is at $30 or $100. Result? Supply is structurally inelastic. It doesn't respond to price signals the way textbook economics says it should. And here's the kicker. It takes 5 to 8 years to develop a new mine from discovery to production. Most new mining projects right now are focused on copper and lithium for the electric vehicle revolution. Nobody's developing new primary silver mines because the economics don't work when 70% of supply comes as a byproduct anyway. The market is trapped in a supply box with no way out. Let me show you what happened in London last October, because this proves how dependent Western markets already are on Chinese silver. In October 2024, the London Metal Exchange had a crisis that almost nobody reported. Physical silver and LME warehouses disappeared. Traders holding short positions couldn't deliver metal to buyers demanding physical delivery. Premiums spiked to 20% above spot price. What does that mean for you? It means if silver was trading at $50 on paper, physical buyers were paying $60 just to get their hands on actual metal. That 20% premium is pure desperation pricing. That's what happens when paper promises run into physical reality, and there's no metal to back up the contracts. Enter China. In October 2025, China exported a record 660 tons of silver in a single month, almost exclusively to London. Why would they do that? To prevent a catastrophic short squeeze that would have bankrupted major banks holding short positions. These aren't small regional banks we're talking about. These are the institutions that underwrite the derivatives markets and provide liquidity to the entire financial system. Wu from Shanghai Metals Market, one of the most respected analysts in the Asian commodity space, explained it bluntly. Exports were driven by London market tightness. China mobilized domestic inventory to ease global constraints. Translation: China saved your market. They dipped into their own stockpiles to bail out Western financial institutions who had sold silver they didn't actually have. And now they're taking their ball and going home. After rescuing London from a delivery crisis, China announces they're cutting off exports starting January 2026. You rescued us once, but don't count on us doing it again. Now, let's talk about the demand side, because this is where it gets genuinely terrifying. Solar photovoltaic panels consumed 232 million ounces of silver in 2024. That's 19% of total global demand. To give you historical context, back in 2015, solar only consumed 60 million ounces. In 9 years, solar silver demand nearly quadrupled, and the acceleration isn't slowing down, it's speeding up. China alone increased solar capacity by 45% in 2024. The International Energy Agency projects global solar installations will add 3,500 gigawatts of capacity by 2028. Have you noticed your neighbor installing solar panels? Your local school district putting them on rooftops? Corporations announcing net zero commitments that require massive solar build-outs? That's not feel-good environmentalism. That's industrial demand for silver happening in your own neighborhood. Here's why you can't substitute your way out of this. Silver is irreplaceable in solar panels. You need 150 milligrams per watt for the silver paste that conducts electricity from the photovoltaic cells. Researchers have tried everything. Copper doesn't work because it corrodes. Aluminum doesn't work because conductivity is too low. It's silver or nothing. There is no plan B sitting in some laboratory waiting to rescue the solar industry. Analysts project solar silver demand will hit 273 million ounces by 2030. But here's the kill shot that should wake you up. A 2025 study published in Science Direct, this is peer-reviewed research, not some blog post, forecasts that by 2030, total silver demand will hit 48,000 to 54,000 tons per year. But supply will only meet 62 to 70% of demand. Read that again. Supply will meet only 62 to 70% of demand. That's not a deficit you can work around with higher prices or better technology. That's a structural collapse. That's the mathematics of shortage becoming permanent reality. Let me show you the smoking gun document. China's Ministry of Commerce Announcement 2025, number 68, issued October 30th, 2025. You can look this up yourself. The key provisions are crystal clear. 80-ton minimum production requirement for export qualification. 40 tons if you're in Western regions. Proof of continuous export activity from 2022 to 2024. ISO 9000 and ISO 14000 certifications. a credit line of 200 million yuan, which is about 28 million US dollars. This effectively disqualifies 90% of current silver exporters overnight. Only state-controlled giants like China Non-Ferrous, Metal Mining Group and Zhejiang Mining Group meet these thresholds. Dozens of private exporters who've been in business for decades, gone. Regional suppliers with established customer relationships, eliminated. Small and medium-sized operations that actually move metal efficiently, cut out of the market entirely. Industry insiders are calling this the rare earth playbook version 2.0. Remember what happened in 2010? China produced 97% of rare earth elements. When geopolitical tensions flared over disputed islands, they cut exports to Japan. Japanese tech companies couldn't get dysprosium or terbium. Production lines for hybrid car motors shut down overnight. It took Japan nearly 5 years to develop alternative supply chains, and it cost them billions. Now, China's doing it with silver, which is even more critical because it powers solar, 5G, AI, and electric vehicles simultaneously. You're not talking about one industry getting disrupted. You're talking about 4 mega trends of the 21st century, all depending on a metal that's about to become geopolitically weaponized. 4-year structural deficit. Inelastic supply that can't respond to price. London bailout proving complete dependence on Chinese exports. Exploding solar demand with no substitute materials. Government export lockdown eliminating 90% of suppliers. Every piece of evidence points to the same conclusion that you need to understand right now. Western markets are about to lose access to 13% of global silver supply just as demand is hitting all-time highs and inventories are sitting at decade lows. This isn't speculation based on chart patterns or momentum indicators. This is documented fact, backed by government announcements, peer-reviewed research, and market data you can verify yourself. The proof is irrefutable. The question is what you do with it. Let's be precise about when this blows up. January 1st, 2026. That's when China's new export restrictions officially activate. Companies that don't meet the 80-ton production threshold get barred from exporting silver. Based on 2024 data, this eliminates approximately 90% of current exporters, not reduced, eliminated. January through March 2026 is historically peak season for Western solar installations. Spring construction season. U.S. and European solar manufacturers will be placing orders for silver paste to keep production lines running, and they're going to find out their Chinese suppliers can't fulfill orders. Contracts will be breached, delivery dates will slip, project timelines will collapse. Then comes March 2026, when COMEX silver futures contracts expire. Traders holding long positions will demand physical delivery. If Chinese exports have dried up and COMEX warehouses are depleted, they're already down 10% from September peaks. We're looking at a delivery failure, the same scenario that nearly collapsed London in October 2024, except this time, there's no Chinese cavalry riding to the rescue. The clock is ticking. You have 36 days before the supply chain breaks. Here's the math that matters for your portfolio, your savings, your investment decisions. Current state as of December 10th, 2024. Silver is at $62 per ounce. Gold is at $4,200 per ounce. That puts the gold to silver ratio at 67.7 to 1. Historical context you need to understand. The long-term average gold to silver ratio is 67 to 1. We're right at that level. But the natural mining ratio, meaning how much silver gets pulled out of the ground compared to gold, is 7 to 1. 7 ounces of silver mined for every 1 ounce of gold. During the 1980 Hunt Brothers squeeze, the ratio hit 17 to 1. During the 2011 QE2 rally, when the Fed was printing money, it hit 31 to 1. If gold holds $4,200 and the ratio just stays at the historical average of 67 to 1, silver targets 62-69. We're already there. But that's the baseline assuming normal market conditions. Do we have normal conditions? Not even close. Let me run the supply shock scenario with you. In 2024, China exported 4,200 tons of silver. That's 135 million ounces, 13% of global supply. Global annual demand is 1.21 billion ounces. If China's exports disappear, That's an 11.2% immediate supply reduction hitting markets that are already running a 215 million ounce deficit. New deficit with China lockdown, 350 million ounces. That's 29% of total demand going unfilled. A 29% deficit is unprecedented in modern commodity markets. For context, the 1980 silver spike that took prices to $50, that was driven by a 15% deficit. The 2011 rally that hit $49, that was an 8% deficit. We're talking about a supply crisis twice as severe as the Hunt brothers squeeze that nearly broke the silver market 45 years ago. Price targets you should be watching. Conservative scenario, assuming just ratio reversion, $62 to $65 by Q2 2026. We're essentially there already. Moderate scenario factoring in supply pressure, $75 to $80 by June 2026. Aggressive scenario, if industrial buyers start panic hoarding inventory, $85 to $95 by September 2026. Catastrophic scenario, if COMEX or LME experience cascading delivery failures, over $100. And at that point, price discovery breaks down entirely. The higher end of this range becomes probable when Western industrial buyers realize they can't source silver and start panic hoarding inventory. When Intel, Tesla, First Solar, and Siemens all try to lock in 6 to 12 months of silver supply simultaneously, price becomes irrelevant. Availability is what matters. You can't manufacture semiconductors or solar panels with promises and futures contracts. Here's the scenario nobody's pricing in yet. On November 6, 2024, the U.S. Geological Survey added silver to the critical minerals list. This designation allows the president to impose Section 232 tariffs, the same mechanism Trump used for steel and aluminum under national security provisions. Proposed tariff range, 25 to 50% on imported silver. Now, imagine this timeline hitting simultaneously. Q1 2026. The U.S. imposes 25% tariffs on silver imports under national security provisions. At the exact same time, China's export restrictions eliminate 90% of exporters. Result: silver gets trapped in producing countries with nowhere to go. Mexico produces 24.5% of global silver. If the U.S. imposes tariffs, Mexican silver becomes less attractive to export to America. If China can't export either, where does Western industry source the metal? Peru? Also facing potential export quotas. Chile? Silver is a byproduct of copper mining, so production is fixed. Australia? Already committed to long-term contracts with Asian buyers. You end up with a global supply chain fracture where silver physically exists but cannot move to where it's needed. This is when physical premiums explode beyond anything we've seen. In October 2024, premiums hit 20%. In a double restriction scenario, Chinese export ban plus U.S. import tariffs hitting together, physical premiums could reach 30 to 40% by Q2 2026. That means if futures trade at $70, physical silver trades at $98. Think about what that does to any industry dependent on steady silver supply. Let's talk about who loses first when this supply shock hits. Solar manufacturers like First Solar, Jinko Solar, Trina Solar, all dependent on steady silver supply for panel production. A 30-day supply disruption doesn't just slow production, it shuts down production lines completely, contracts with utilities get canceled, revenue projections collapse, stock prices follow. Electronics giants like Intel, TSMC, Samsung, they all use silver in semiconductors and AI server production. Those massive data centers powering ChatGPT and cloud computing, they require silver for cooling systems and electrical conductors. A shortage doesn't just slow chip production, it halts it completely because you can't partially manufacture a semiconductor. Automotive producers like Tesla, BYD, General Motors, all electric vehicles use 18 to 34 grams of silver per car for sensors, contacts, and battery management systems. EV production targets for 2026 assume steady silver supply at predictable prices. If supply disappears and premiums spike, EV rollout plans collapse. Climate commitments get pushed back. Investment theses fall apart. These aren't small players we're talking about. These are multi-trillion-dollar industries running on just-in-time supply chains. They carry 30 to 60 days of inventory because holding more ties up too much capital. If Chinese exports stop in January and physical premiums spike in February, they're forced to choose between two terrible options: pay whatever price necessary to secure silver, or shut down production lines and breach contracts. Either scenario sends silver prices parabolic. Here's what you need to understand as we close this out. This isn't a prediction based on technical analysis or chart patterns. This is a timeline backed by government documents, commodity data, and mathematical certainty. 36 days until China's export restrictions activate, 90 days until Q1 solar demand peaks, 120 days until COMEX March contracts expire. The trap is already set. The only question is how violent the repricing will be when Western markets realize they've lost access to 13% of global supply during a 215 million ounce deficit that was already pushing the market to the breaking point. China spent October 2024 bailing out London's silver squeeze by exporting a record 660 tons. They opened their vaults, they mobilized domestic inventory, they saved the market from a catastrophic delivery failure that would have bankrupted major financial institutions. Now, they're locking the vault and walking away. When Western industrial buyers realize they can't source physical silver in the first quarter of 2026, when solar manufacturers can't get paste, when electronics companies can't get feedstock, when automotive producers can't get the materials for EV sensors, the panic will make October's squeeze look like a warm-up act. The smart money isn't waiting for confirmation in the financial headlines. They're not waiting for CNBC to explain what's happening after prices have already moved. They're positioning now, before January 1st, before the supply chain breaks, before physical premiums detach completely from paper futures. You have 36 days to decide which side of this trade you're on. Are you positioned for a world where 13% of global silver supply disappears while demand hits all-time highs? Or are you waiting for permission from analysts who haven't even read China's export announcement yet? After January 1st, 2026, when those export restrictions activate and Western markets discover what a real supply shock looks like, it's too late to reposition. The move will have already happened. The only question left will be whether you saw it coming. The clock is ticking.